No, but I can't be a therapist on this one. So pick up your quizzes, and if you don't, they're just going to recycling at the end of the semester. So it's good to pick up your quizzes for the simple reason, which is I am not the Pope. I am not infallible. So if I've screwed up on your grading, the only way I will know is if you check your quizzes and make sure you come and let me know. Okay? So how many of you would classify yourself as contrarians? Okay. That's good to know. So how many of you actually bought something today? That's good. That's the test of contrarian, right? Which is, are you going, today is the kind of day where you can be honest with yourself, because I actually teach a class called Investment Philosophies, which I've never taught at Stern. I teach only online, so it's an online class, where essentially here's what I look at. You look at the books, there are so many ways in which people seem to make money, right? Books about Warren Buffett and Peter Lynch and about, Jesse Livermore, and you read the books and you say, this looks easy. There are so many papers that seem to show that you can make money, right? If you do this, you'll make money. If you do this, and then you look at a reality which is most active investors don't seem to make money. So I start with that premise of, hey, there seem to be so many pathways to heaven, but how come so many people end up in hell? And the question I had to ask was, it can't just be that if you know what a particular way of investing is, that you can go out and do it, because psychologically you might not be ready or suited for that philosophy. On paper, contrarian investing looks good. In practice, contrarian investing requires a special kind of stomach that you might not have, and if you try to do it, you'll either throw up or do something worse. So days like today are the days where you kind of gauge, am I really a contrarian in word or contrarian in practice? So keep a sense at least. It's never fun to go through periods like this, but it's also a time to kind of gauge what your reaction is, how you react, because that should play out. So let's take that to the next step. You're a contrarian. You're going to go buy. What are you going to buy? What did you buy? S&P 500 ETF. You didn't buy the Carnival Cruise Lines shares? And in fact, there's a difference between blind contrarianism, which is pick the stocks that have gone down the most, buy it and hope they recover, which I think is a terrible strategy. I don't see how it can make, and kind of refined. So you are betting on the market reversing itself. That's a pure luck bet, right? In a sense, you have no way. If it's a market timing issue, the momentum issue. But if you were picking stocks as a contrarian, what would you be looking for in your stocks?
High betas.
You want high betas? You want a short high. That's a market timing one as well, right? So in a sense, you're betting in the opposite direction, right? So it's a momentum bet. But let's say you're a contrarian investor, you want to pick something
where your hypothesis that their fundamentals have not been materially infected, which.
So let's go to say S&P Capital IQ. We're going to run some screens for those kinds of companies. It's going to be difficult because the financials haven't been updated yet, right? So by the time you find out they haven't been affected, it's going to be too late. So we almost have to make a judgment call. Let's take the oil sector. It's been a horrific day, right? It's been a horrific week. It's been a horrific decade. But the last 2 weeks, oil price, today oil price is at $32 a barrel. Would you buy oil companies? And if so, what types of oil companies would you want to buy? Do you think oil will go back up? At $32 a barrel, the only company in the world that can actually produce oil and make money is Aramco. Everybody else. And Aramco can't produce enough oil for the whole world, because then they'll suck up all the oil from under the ground. Remember, it's not a renewable resource, right? There's 330 million barrels. So if you produce, right now they're selling 9 million and they're going to push it up to 11 million. But if they produce 30 million, that's 11 years, what's left? There'll be nothing left in Saudi Arabia. So the reality is this is not a long, or even a short-term steady state. So let's say you believe oil prices will go back up a year, 2 years from now. What types of oil companies would you look for to buy? Well, you could go midstream, downstream, upstream, but basically first you want, if you're looking at companies that produce oil, you want companies that have access to lower cost reserves, right? Because it's, you don't. Second, would you look at the debt that these companies have? Because even if you're right about oil prices bouncing back up, what has to be true about your company for you to benefit? It's got to survive. Otherwise, all you get is bragging rights, right? Which is, hey, you know what? If only this company had survived, I'd have made a lot of money, but that's not going to make you actual money. So here's what I would do. I mean, I'm not suggesting any investment advice here, but if you think oil price, go to S&P Capital IQ. This is one of the great things about having access to it. You can download how much debt they have, what their market cap is, what their EBITDA is, and you can also download how many reserves of oil and what it cost them last year. And then you're looking for your trifecta. You want companies that have very little debt, have at least a portion of their reserves in low-cost reserves, and essentially you're making a bet on oil prices going up. Now, so again, it's built on the premise that this is a cycle, that this is not the permanent oil price, but that's why I picked Carnival Cruise Line. Carnival Cruise Lines is not an automatic bet, right? This is not like, hey, once this passes, people will jump on cruise ships. Would you ever get on a cruise ship in the rest of your life? I mean, this might have ruined this business for life, right? Because what you have is an example of, hey, if it's not this virus, it's a petri dish on the ocean with a lot of old people on it. It's just asking for trouble. It's just, I'm not sure Carnival Cruise Lines can make it back from this. Airlines a little trickier, right? Because some of the leisure travel is gone for this year. It's not like they're going to make up, but to the degree that an airline that caters to business traffic, again, what you're betting on is not that earnings will not drop this year. Earnings will drop this year, but how much of those earnings will come back? Those are the companies, if I'm a contrarian, I'm looking at companies that will report lower earnings this year because of the virus playing out, but you believe that this is not, this is not canceled consumption, it's delayed or deferred consumption. So take a look at the business mix and see if you can make some judgments. Yeah?
Could you look backwards and see how rebounds happened with similar?
Yeah, but you could try, but in a sense, every crisis is unique. For instance, the 2008 rebound was a rebound built around financial service companies. So the kinds of things you'd have looked for there would have been very different because there the concern was the closer you were tied to financial service companies, the more pain you felt. So there the rebound happened as those banks recovered, you basically took. So in a sense, with each crisis, there's something different that drives. The kind of panic you see might be exactly the same, but what the correction when it happens will be different. So I think you almost have to kind of take a pencil and paper and say, these are the companies that I think are permanently damaged. These are the companies that I think are temporarily damaged and will come back, maybe some of the way. And these are the companies that are temporarily damaged and will come back all of the way. And of course you could say, why can't we just look at companies that are benefiting from that? Because it's only a handful of companies, right? How many Zooms can you find? I mean, Zoom benefits because, and in a sense, one of the things Zoom benefits from is not just a temporary surge in the usage of Zoom, that people try Zoom and they discover that they like it. And they said, this is better than that meeting we used to fly to in Hong Kong where nothing got done. We all had jet lag. We were sleeping during the meeting anyway. That's the kind of long-term impact you're looking for in both directions. So as you look, there are no easy places in this market. And when you hit that buy button, your stomach is going to be in a ball. I mean, that's human nature. If it's not, you have sociopathic or psychopathic tendencies, which is a really good characteristic to have as a trader because you have completely separated from your emotions. It is natural to feel. Now I want to make sure that nobody's sitting around you. Maybe, did you feel a little, as you bought the S&P 500, I hope you felt a little good. Okay, so he's not a sociopath. You don't have to worry about it. But I'm saying that, no, I'm serious. You should feel emotionally a little torn about what you're doing because you're going against the crowd. So, I don't know how many of you started this. Anybody doing an oil company for this class? Valuing an oil company? Who are you doing?
Oil for neighbors.
Neighbors, okay. How much debt do they have? That's the first thing I would check, is they might not be around by the end of the semester if they have too much debt. I mean, that's a second layer impact, right? Because even if the panic subsides, there is going to be that second layer of financial impact. And that was what was so tricky about 2008. It wasn't just the panic, but the kind of debt crisis it created among companies. So a good screen to run an S&P Capital IQ is companies that have very little debt, because in a sense, at least on that debt crisis, you know you're going to get some solidity. Okay? But many of you are going to have to face that reality that the ground shifted under you while you were doing your valuation. You know? And think of it as thank God it wasn't real money at play while you were doing this, you know, or if it was, you're feeling it a lot more. So let's go back and talk about fundamental growth. Okay? Let's assume I come to you with a company which has a 75 million in after-tax operating income and invested capital of $1 billion. So that's a return on capital of about 7.5%. This company has told you up front, it plans not to reinvest any more money. It's going to take the 75 million out every year. Okay? So if you don't plan to reinvest any money, which of the following statements is true? The company cannot grow. The company cannot grow in the short term. The company cannot have sustainable long-term growth, or the company would shrink. So basically, I've given you the return on capital. I've told you that they've stopped reinvesting. That's all you know about the company. Okay? The existing return on capital and the fact that they will not reinvest in the future. Which of the following is true? How many pick A, that it cannot grow? Period. Nobody? Cannot grow in the short term? Nobody. Cannot grow in the long term? It cannot grow in the long term because if you really are not reinvesting, but if it grows in the short term, what's causing it to grow? Just look at the math, right? 7.5% return on capital, $1 billion in invested capital. So if you've stopped reinvesting, what have I just said? Your invested capital stays frozen. Because reinvestment of zero doesn't mean you're shrinking, you're keeping your invested capital base. So what has to happen to the return on capital? It has to go up. If the return on capital goes up, you will grow, and that's called efficiency growth. So in fact, if I told you that the return on capital will jump from 7.5% to 10% next year, what will the growth rate be next year? Just set up a hypothetical example. $1 billion, they were making 75 million last year, right? Now they go to a 10% return on capital. 10% of $1 billion is 100 million. So you've gone from 75 million to 100 million. That's a 33.33% growth next year. The year after that, they can go to 12. That's another 20% growth. As your return on capital changes, your growth rate will reflect those changes in both directions. There are two ways you can grow, and we're going to talk about this as the start of class today. You can grow by reinvesting, increasing your capital base, or you can grow by becoming more efficient. The problem with efficiency growth is you can't keep it up forever. Why? You can get more efficient, but there's going to be a ceiling, right? You hit that ceiling, you're done. That's why you cannot create long-term growth with efficiency. If you tell me your company is going to have higher growth for the next 5 years because it gets more efficient, I'm all with you. But then you get to your terminal value and you say, look, my company is going to grow 2% a year forever by being more efficient. I can't go along with that because that effectively means your return on capital is to hit infinity and keep going. So today we're going to talk about efficiency growth, and in a sense, it's really a cautionary note because many of you will try that sustainable growth equation for your company, and you're going to discover that the growth rate you get is really low. And many people stop right there. They say, my growth rate is 3% because that's what the sustainable growth equation gives me. But I'm going to go further and say, well, you've got to ask a follow-up question. Is there at least a potential for efficiency growth? So let's go back and revisit the sustainable growth equation. And this was a valuation of Cisco and Motorola that I did in 1999, where I compared the two companies. So let's take Cisco. Reinvestment rate of 107%. Remember why it's so high? They did all those acquisitions, the reinvestment went up. And I said at that time, don't pass judgment on whether this is good or bad, because it's only one half of the equation. It tells you how much they reinvested. What was really impressive about Cisco in 1999, this was the peak of their glory, was the return on capital was 34%. If I made the assumption, and this would have been a terrible assumption in hindsight, in 1999, that they could keep doing this, reinvest 107% and have a return on capital of 34%, their expected growth rate going forward would have been about 36.4%. Why is it so high? Because in a sense, they've discovered the magic. They're reinvesting a lot and reinvesting well at the same time. Does anybody know what happened to Cisco in the next decade? 90 through 99 was Cisco's decade. They went from $4 billion market cap to $400 billion. They hit essentially everything they tried turned to gold. 99 was, in a sense, their peak year. Then the dot-com boom bust. And Cisco was not a dot-com stock, but it benefited from the infrastructure of the internet. Basically, it supplied what made the internet work. During the next decade, one of these two numbers remained pretty stable, and one imploded. So this is an easy one. Which one do you think remained stable? The reinvestment rate stayed high. Why? Because that's what Cisco had always done. It had worked. They kept doing acquisitions, reinvesting a lot. The return on capital of 34% collapsed. So for the next decade, Cisco's growth rate became much lower, and it wasn't because they weren't reinvesting enough, it's because the return on capital had dropped off. So the cautionary note is your company can look incredibly good right now in terms of return on capital and reinvestment rate, but your job is not done. You have to make a judgment on what will it look like in the future, because that's what's going to drive your future growth rate. In contrast, if you take Motorola has a not bad reinvestment rate, 53%, and a not bad return on capital at 12%. What's not bad times not bad? Not bad, and they have a not bad growth rate of 6.5%. So if you have a company with a not bad growth rate, would they like to grow like Cisco? Yes, but pigs can't fly. I'm not suggesting Motorola is a pig, no, but there are some companies that are so saddled by having a low return on capital that kind of puts a ceiling on how much they can grow. So when you look at the growth rate for your company, dig a little deeper to see where that growth is coming from. Is it coming from incredibly good returns on capital? Is it coming from reinvesting a lot? Or is it coming from improving margins and returns on capital? Because that's what's going to drive what your forecast for the future is. So let's take, if you look at all of these numbers, the key number in all of the sustainable growth equations is an accounting return. It's a return on equity if you're looking at equity earnings growth or a return on invested capital. And it's a number in finance that scares me the most, because both the numerator and the denominator of a return on invested capital are accounting numbers, which means everything accountants do at the company can affect my return on capital. I have a paper that's so incredibly boring I fell asleep multiple times reading it I'm writing it actually while I was, forget about reading it. While I was writing it, I fell asleep on measuring. Forget about the future. Measuring last year's return on equity and return on invested capital of the company. You see, what's the big deal? It's easy. Mechanically, it's easy. In the numerator, you have after-tax operating income, EBIT times 1 minus D. And in the denominator, you have the capital invested in existing assets. And the way we measure it is by taking book value of equity plus book value of debt minus cash. It should all be there, right? You go to the income statement, there's operating income, you get an effective tax rate, you get book value of equity, book value of debt. You're saying, what's the big deal? Everything, as I said, accountants miss or misdo in your book value is going to affect your return on capital. Let's take the two big things that we got caught up on in earnings, right? We capitalized R&D and we capitalized leases. And when we capitalized R&D, we were quite open about the fact that capitalizing R&D does nothing for your free cash flow. It's exactly the same free cash flow to the firm. Saying, why did we do it? It's because we wanted to get a better sense of what the return on invested capital is. Because when you capitalize R&D, you're getting a better sense of what's invested in a company that has a lot of intangibles and a better sense of what their return on capital is. Same thing with leases. If you don't capitalize leases, you're misestimating the return on invested capital at a retail firm or a restaurant, so we capitalize leases for that reason. But there are layers here that can create huge headaches. I'll take one example. Let's suppose you have a company that takes a terrible project. Chevron in 2012 invested in a gas project of Australia, $30 billion project. When it made the investment, oil prices were $100 a barrel. So invest $30 billion, expecting good times. The project took 4 years, huge infrastructure investment, 4 years to come online. By the time the project came online, oil prices had dropped to $50 a barrel, and the project, in hindsight, was a terrible project. In fact, it was so terrible, everybody agreed it was terrible, including the accountants. And when everybody agrees that a project is terrible, what's the next step? What do companies do? They wrote it down. They took the $30 billion project and they wrote off half the investment. Sounds like a sensible thing to do, right? But think of what it does if you're a person not knowing this 2 years later looking at Chevron's return on invested capital. You get the after-tax operating income from 2017, that might be a solid number. Then you take the book value of equity, book value of debt, and cash at Chevron. So when you write off $15 billion, what happens to your book value of equity? It's going to drop by $15 billion. You're taking it off the books. And if you don't realize it's been taken off the books and you compute the return on invested capital for Chevron, what do you conclude? Great company. Look at its return on capital. So what do I need to do? Here's the nightmare scenario. I have to go reverse everything accountants have done over the lifetime of the company. God help me there. To get a sense of, is my company earning a high return on capital or low return on capital? So when you look at these numbers, it might seem like it's easy to get, but so if you look at all those things I'm talking about, things which can affect book value, I'm worried about how it plays out in return on capital. And the reason I worry about return on capital is it's a key number driving my growth rates and the value of my growth. So now let's complete this cycle. Yes, Gabe. In fact, invested capital can be negative for companies. Why? For a couple of reasons. Why can it? So give me the scenarios where it turns negative. Well, book value of equity can be negative. 1 in 9 companies in the U.S. has negative book value of equity because if you keep losing money at some point, hit zero, or you do a big buyback, so 1 in 9 book value of equity can be negative. But even if your book value of equity is positive, you can end up with negative invested capital if you have a huge cash balance, right? Which can sometimes happen with companies which have, especially if you don't capitalize R&D at technology companies, you can very quickly, and Apple for a long time, the largest market cap company, had negative invested capital, while the cash balance exceeded the book equity and the book debt. So when invested capital is negative, what should you do? Just abandon return on invested capital altogether, at least for last year. It doesn't mean you can't think about it in the future. Because remember, what drives return on invested capital in the future is competitive advantages, barriers to entry. So think about it in qualitative terms. And one reason I always compute industry averages is because I want to get a sense of what a typical return on invested capital is, especially when I run into a company like this where its own numbers tell me very little. Right? Let's talk about changing returns on capital. I'll give you the logic, right? You can have a company that reinvests nothing, but if its return on capital changes, there's going to be an efficiency effect. You double your return on capital, you're going to have a 100% growth rate in the year that you do it. If you double it over 5 years, then you're going to have a 20% additional growth rate every year for the next 5 years, roughly speaking, if you don't count the compounding. So if you gave me a company where the return on capital is changing, there is a second term I've got to bring into the growth component. So I'll take return on capital times reinvestment rate, but then I'm going to look at the efficiency growth by looking at how much your return on capital is changing. So let's take Motorola. Remember I came up with the not bad times not bad is not bad, 6.5% growth rate. When I valued Motorola in 1999, I made the assumption that the worst days of Motorola were behind it, that they could improve their return on capital going forward. I assumed that the return on capital, which was 12.18%, over the next 5 years would increase to 17.22%. That's roughly a 5% increase in the return on capital. On a percentage basis, 5% improvement on 12% return on capital translates into about a 40% growth rate over the next 5 years. I could just, if I were in a hurry, I could divide that by 5 and say that's 8% more growth. But if you want to get a little fancy, remember growth compounds, I took that change and I computed a compounded average growth rate, but that should be raised to the power 1/5, not multiplied by 1/5, raised to the power 1/5. So essentially I'm looking at the compounded average growth rate, and that number gives me 16.29%. If I ignore the efficiency growth, I'd have ended up with just 9.12%, but because I'm giving them the benefit of improving their return on capital, the total additional growth rate that I'm getting from efficiency is another 7%. But if you look at that improvement, what is it a function of? How much return on capital changes relative to existing return on capital. If you have a 40% return on capital, it's very difficult to get a lot of efficiency growth, because where do you go from 40% to 44%? 40 to 44% is just a 10% increase. But let's say you have a 4% return on capital right now. You're a terrible company. This is one of your few glimmers of hope, right? You're already down in the basement. If you can make a 4% return on capital into an 8% return on capital, That's 100% increase in your earnings. So if any of you are working with companies, bad companies, companies with terrible returns on capital, at least look at this possibility of efficiency growth giving them this boost. So I'm going to show you 5 companies. And they all have the same growth rate. But I want you to rank the companies from highest value growth to lowest value growth. So think like an investor. They all have a 10% growth rate, but the way they get there is different combinations of how much they reinvest and what return they make on their projects and what their efficiency growth is. Right? So mathematically, the growth is 10% for all of them. Their cost to capital is 10% in case you need that in this conclusion. So you had a chance to look across the 5 companies? Which of these 5 companies has the most valuable growth and why? They all have a 10% growth rate, but I'm going to argue that in a couple of these companies, the 10% growth rate is a really good thing for you. In one of these companies, it's actually devastatingly bad that they're growing at 10%. Let's start with that one first. Which of these companies is creating the least value, actually negative value growth? And what is it about 3? The 5% return on capital is actually lower than the 10% cost of capital. They're growing, but they're destroying value. So they can get a 10% growth rate, but every time they grow, they're making you a less valuable company. So 3 is the worst. What's the best? Because I think you can make a case for 2 if you just think about next year. There are 2 companies that can compete for next year. But if you think long term, which is the best? 1, why? Because it has the 10% growth rate, but it got there with relatively low reinvestment, 20% reinvestment and a really good return on capital. So 1 is the best because not only do you get high growth next year, but you're going to continue to get high growth and it's really high quality growth. 1 is the best, 3 is the worst. You want to fill in the middles? Which one is neutral, where you don't care that they're growing? 2, return on capital is equal to the cost of capital. There's no efficiency growth. This company is growing, but it's earning exactly what its cost of capital should be. So think of 2 as somewhere in the middle. It's 0. Efficiency growth-wise, these 2 companies both have efficiency growth. Right? But from 5, it's all efficiency growth. So after your growth rate next year, you're going to go to a 0% growth rate. Company 4 has some efficiency growth and some long-term growth. So what you're looking for is not just is it high value growth or is it low value growth, but how sustainable that growth is. Because the more sustainable growth is, the more value it is, and the higher the return that a company is at growth, the more valuable it becomes. So when you look at growth rates, and often all you get when companies is the growth rates, you have to start differentiating between the companies where that growth is worth a lot and companies where it isn't. So let's complete this growth discussion by looking at the most general case. Because all through the 4 examples that we talked about, we look at everything with operating income as the base. We look at growth in operating income. And the problem with focusing on operating income is you might miss the fact that in some companies, it's really revenues that are growing, and what you're hoping for is eventually margins catch up. So here's my most general growth formula, and this is what all of my simple Ginzu models are built around. It's built around 3 big numbers. The first is, I look at revenue growth. And what am I going to look at to make that judgment? I'm going to look at their past. I'm going to look at the total accessible market. So you look at the Tesla example, the revenue growth came from whether I call them an automobile company or a tech company or an auto tech company. So the revenue growth makes my small revenues into big revenues. The second big assumption I make is about margins evolving over time. And margins can stay stable, in which case your growth rate is going to look very much like the fundamental growth rate. They can increase over time from negative to positive, from low to high, or they can decrease over time. So that gives me, so revenues times operating margin gives me operating income. I net out the taxes, that's in the middle, and then I look at reinvestment. And when I'm revenue focused, which is what I am in this model, I have to tie my reinvestment to revenues. Remember, my definition of reinvestment is CapEx, working capital, acquisitions, R&D, they're all in reinvestment. So that's where I come up with the sales to invested capital ratio that you've seen in all my valuations. So if you tell me how much your revenues will grow, I'll figure out how much you have to invest to get to those revenues. So 3 layers. Revenue growth makes revenues now into revenues in the future. Margins will evolve over time, and the sales to capital ratio allows me to estimate how much I reinvest over time. So I'm going to use a very old Tesla valuation, and you can use the updated Tesla valuation to see how it's changed in 5 years. But 5 years ago when I valued Tesla, I had a story to tell. It was a much smaller story. A story of Tesla becoming a luxury auto company. You're saying, who cares whether it's luxury or mass market? Well, the biggest automobile companies like Toyota and Volkswagen tend to be mass market auto companies. The most successful luxury auto companies often have revenues of 70, 80 billion. They can't get, because you don't sell that many cars. So I gave them revenues of about, if you remember in my 2020 valuation, I gave them revenues of 125 billion. I gave them revenues of about 80 billion. So my revenue growth rate essentially gets me from where I am now, 2 billion, to 79.5 billion. Now the question you might ask is, how did I come up with the 65% growth rate? I backed into it. You know what I mean by backed into it? I have my starting revenues. I said I want my end revenues to be roughly 80 billion because that's what a successful luxury auto company is. The growth rates to me are just a means to an end. So when you sit with my spreadsheet saying, should I use a 20% growth rate, a 30% growth rate, turn your attention to the revenues in year 10 because the story you're telling is about how big you think this company will get. So I've made my company, at least on my spreadsheet, go from being a small company, 2 billion, to revenues of 79 billion. Incidentally, my 5-year forward forecast of revenues for Tesla was about 24.7 billion, which is exactly what they generated last year. So, I mean, it was just pure chance. But they're following actually a pathway more to the luxury auto business, which is interesting because they're, if they're making a pivot, it has to be from the Tesla 3 kind of kicking into high gear. For the margins, again, I start with their existing margins, which are not good, minus 1%. If I leave it at minus 1%, I know exactly what's going to happen. The company is going to be worth nothing. I have to pick a target margin. And at least in 2015, I still saw them purely as an automobile company. I didn't see any tech, software stories. So in my recent Tesla valuations, I've opened the door to that becoming a business model. But in that case, I said, I'm going to give them a luxury auto company margin. And I went to the 75th percentile of auto company margins. Again, having the data helps you. And having access to capital like you, we can all have the data. So as I go through time, my low margins are becoming high margins. Now you're saying, how do I come up with the intermediate numbers? Keep it simple. I just took the difference divided by 10, steps. It doesn't matter how you in fact get there. What matters here is what's my end number. If I use an 8% margin, the effective value is going to be much, much greater than whether I move in small steps or large steps. We'll come back and take a closer look because this really defines your pathway to profitability. And we'll give ways of kind of making it more steep or less steep. But really, the end margin is the key number. Yep.
So even though you have your 10-year target, when you went through your revenue growth, did you just do, like how did you come up with?
Basically what I do is, you have a 5-year compounded growth rate because I don't want to do year 1, year 2, because you're going to go crazy if you try to do your specifics. I have a 5-year growth rate, then the 5-year growth rate scales down to the risk-free rate in steady state. So all I do is I change the 5-year growth rate and I check my 10th year's revenues. So I have to have a sense of what my revenues will be in my story to be able to do this. So my growth rate to me is just a number I mess with until I get revenues that reflect what my story should tell. And that's the way, if you have a young company, you're doing Beyond Meat, or if you're doing Casper, you need an end game. And there's no way around it. And that's why the story matters so much. If I define Beyond Meat as a meatless meat company, my end revenues will be very different than if I define them as, it could be vegan, beyond milk, beyond fish. I don't even want to go there, but maybe they can come up with vegan alternatives. That's a much bigger market. So the story you tell is a big driver of what those end revenues are going to be. Yes?
Does it have to be a constant growth?
No, it doesn't have to be. I mean, in a sense, what happens in years 1 and 10 is completely under your control, right? So if you want to use, but the thing is, don't get too fancy, right? So if you want to do year 1's growth rate because you have some transparency on it, the numbers are already starting to come and say, I'm going to do year 1, kind of disconnect very quickly because if you try to do this year by year and you go sequentially, by the time you get to year 5, you'll have no hair left because you pulled it all out. And by the time you get to year 10, you're going to give up because you're going to be facing this uncertainty as you go out in time. That's almost, you really can't bring it into the numbers. So that's why having a story gives you that ending number. And then you can at least isolate your attention to how do I get from where I am today to where I need to be. Okay. Now the final loose end here is to get from a $2 billion revenue to $80 billion as an automobile company, I have to build assembly plants. The Fremont plant is not going to do it. It can produce maybe $20 billion worth of cars at the most. And the way I bring this in is through the reinvestment number. And as I said, again, I'm going to keep it simple, simply because I don't want to be forecasting CapEx, depreciation, working capital, R&D, acquisitions for a young company, partly because they have no idea how they're going to be growing. But I do know Tesla will have to spend money. And the way I estimate it is I use the sales to capital ratio as a way of estimating reinvestment. That 1.55 that you see there is what typically automobile companies generate in revenues for every dollar of invested capital. Remember in 2015, my story for Tesla was auto company, auto company, auto company. Which means to get my revenues from 2.01 billion to 3.3 billion, I need to reinvest. So if you take the change in revenues and divide by 1.55, I need to reinvest 844 million. So every year I'm taking the change in revenues dividing by the sales to cap. Okay. Yep.
So for something like this, where you're actually building physical plants,
There may be a time lag, right? Is that what?
it might take like 2 years for that.
And you know how you do that? If you want to build in a time lag, what do you need to do? What will my reinvestment in year 1 be driven by? My change in revenues between years 3 and 4. So there's actually nothing in this model that prevents you from lagging the reinvestment to the change in revenues in a future year. Which might, with Tesla for instance, for the first 5 years in my most recent valuation, I gave them a much higher sales to capital ratio. Why? Because they built up enough capacity to get to 600,000 cars, and I'm going to let them coast for a while. But if you're investing for the future, you're going to be reinvesting now for your revenue growth. So all you need to do when you do that reinvestment is lag that number by change in revenues in year 3, change in revenues in year 4. So it's an incredibly flexible approach because you can bring in long lags between reinvestment and growth, but bring it in through your own decision on how much to lag it. Okay? Now, of course, here's where you see story matters. You know what the Tesla story is now, right? Much higher revenue growth because not only will we get autos, but we'll be selling software on the side and other stuff on the side, maybe service on the side. We'll have much higher margins because tech companies make higher margins than the software business. And we're going to be able to reinvest less like an automobile company and more, and that story is still unformed because right now they're investing like an automobile company. But maybe they can find a way to make this more like a tech company because the average iPhone is, 35% of its price, the cost is there. So you actually have to figure out a way to change the economics of this business. Is it plausible? Yes, but you have a tough selling job to do because you're now selling a much bigger and a much more complex story, a story that no manufacturing company has ever told before. Okay. We'll come back and talk about the story part more because as you can see, especially with young companies, the story becomes critical, and being honest about the story with yourself is key to making sure you're not coming up with dreams rather than values. Okay? So let's summarize what we have with growth. When you sit down to estimate your growth for a company, start by looking at historical growth. As I said, it might not be that useful, but you definitely should find out what it's growing at. Factor in that if you have a small company that's become bigger, that growth rate might not extrapolate into the future because you have a much bigger base to build on. Second, you can look at analysts' management estimates of growth. But remember, when you do that, you're outsourcing your story. I've never valued a company with management forecasts because if I do that, I've conceded my valuation to management. I will listen to management. I'm not saying I won't. But then I'm going to take the parts of their story that I think make sense and leave the parts that don't make sense. But you can look at and we can look at analysts. And analyst growth rates, as I said, first are often in earnings per share, which are not that useful if you're forecasting revenues. And we know analysts are not that good at forecasting long-term growth. Or you can build it based on fundamentals. The reason I keep emphasizing fundamentals is saying, look, understand the business, understand the market, understand the competition when you're forecasting growth. And try to bring it into the numbers. Just talking about the market and the competition is not going to do it. But the bottom line is the growth number is going to give you trouble because it's about forecasting the future. It's going to give you trouble because you don't like dealing with uncertainty. And at a time like this, when you have macro uncertainty on top of micro uncertainty, it's going to get even more difficult. So I'm giving you advance warning. When you sit down to value a company, the coronavirus is going to be lurking around your valuation. Not physically, I hope, but no, virtually. Yeah. So you have to remember, that's going to make your life more difficult, but remember, you're not alone. Everybody, in fact, most people have given up valuation right now. That's why I said these are the times when you want to start valuing companies, because right now people are just stepping back and say, this is crazy. I'm just going to buy when everybody else is buying, sell when everybody else is selling. No, I'm not looking at cash flows, earnings. That's gone to, forget about the back seat. It's been thrown out of the car. Okay? So now let's talk about that last number we know. So we talked about discount rates, we talked about cash flows, we talked about growth rates. Let's talk about the elephant in the room. When you do a discounted cash flow valuation, by far the biggest number is the terminal value. And if you're not careful with the terminal value, it's going to take over. It's going to hijack your valuation and run away with it. So let's look at why we need a terminal value in the first place, or whether we need a terminal value in the first place. The value of an asset is the present value of the expected cash flows on the asset, right? So if I give you an asset with a 10-year life, I give you a royalty trust. You know what royalty trust is? It's basically one oil reserve, and basically you get the rights to the cash flows from this oil reserve. What the heck are you doing estimating a terminal value? Because after the 15 years and the oil is done, the cash flows are done. So if you have a finite life asset, there should be no terminal value. Because you can, that's why when I valued Aramco, there is no terminal value in my valuation. I have 50 years of cash flows and I'm done. So first, just because you've been taught in discounted cash flow valuation that there's a terminal value doesn't mean you've got to pull it out every single time. So first question is, does my asset have a finite life? If you're valuing a publicly traded company where at least there's a possibility that could keep going, then we have a problem. The problem is you cannot estimate cash flows forever. So what do? To apply closure, you stop at some point in time. When do you stop? When you get tired. Or when your Excel spreadsheet runs to that column and says, no, a new page is going to be printed, I don't want to have an extra year. You stop in year 5, year 10, and you estimate a terminal value to reflect the fact that there are numbers that are going to come in after year 10, but that you're either too exhausted or too uncertain or not quite ready to estimate the number. So that's why we have terminal values, to get closure. So I'm going to give you 3 different ways in which terminal value can be calculated. I'm going to argue that one of these 3 ways should never be used, but gets used almost with every single banking valuation. And the other 2, we'll look at when we might use one or the other. So here are the 3 ways I can get terminal value. I can estimate a liquidation value. You know what a liquidation value is? I get to year 10 and I shut the company down. I sell. So think of it as an eBay terminal value. I don't think you can liquidate a company in eBay. But think of going, you sell off each piece separately, you get whatever you can. So that's liquidation value. The second is to get to year 10 and apply a multiple of what? EBITDA, EBIT, to come up with the terminal value. It's called an exit multiple. And the third is to assume a growth rate in perpetuity after year 5 or year 10. So which of these 3 should never be used in an intrinsic valuation? I mean, I've laid enough foundation in this class, right? If you use a multiple, what are you doing? And be ready for this argument, because as I said, 80% of banking valuations use a multiple. So I want you to be ready with that argument. Against that Harvard MBA says, but we use exit multiples here all the time. What is the argument you need to use as to why you should not use an exit multiple? Well, that's okay, right? So basically, if an exit multiple has an implied growth rate, that's like using the model 3 and then using a multiple. But that's not the way most how do people come up with that 6 times EBITDA or 2 times? They look at peer group. And when you use a peer group to come up with a number, what did we call that up front in class? We talked about you can value something or you can price something. You made your biggest number in your valuation a pricing. This is not a discounted cash flow valuation. It's a relative valuation or a pricing in drag. You know what the drag component is? All those cash flows I got distracted by in the year 10, and while I'm distracted, what do? You slip in 6 times EBITDA into the terminal value and say, trust me, this is a discounted cash flow valuation. It's a forward pricing. There's nothing wrong with a forward, you know what I mean by forward pricing. You're applying the pricing on your 10, there's nothing wrong with a forward pricing. Just don't call it an intrinsic valuation. Okay. Why do people do it? Because you have a pricing job. You got to get transactions done. If you want to justify an acquisition, it's far easier to do it with a pricing multiple than with a discounted cash flow model. So there are two ways actually, not three, to get a terminal value. You can either use a perpetual growth model, which is kind of scary, or a growth model after your, or you can use a liquidation value. When might you consider using a liquidation value instead of a perpetual growth model? Yes?
Book value of the assets are higher than fair value of the company.
You got to be careful. Let's say you have a nuclear power plant. Your book value might be higher at the end of year 10. Why? Because nobody wants an empty power plant, a nuclear power plant, right? You can't make it into apartments. So you got to be careful. Sometimes the book value might be saying, hey, you can't sell this. But I think you're on to something, which is if I have a company where the book value comes from physical assets, where I can get the value of each one. Real estate, for instance, you can say, you know what, I'm running a hotel. At the end of 10 years, I'm going to stop the hotel and I'm going to sell the real estate, which raises an interesting question of how did he come up with the value of the real estate? Maybe he's priced the real estate. So one is liquidation value might be in heavy real estate-based businesses where you have the option of stopping and saying, I'm just going to sell it to the highest bidder. Right? The other is we are evaluating private companies. I know we haven't talked about this extensively, but let's say I'm a doctor and I have a practice and I ask you to value it. It's kind of silly to put a perpetual growth and assume this will go on forever, right? Why? Because I'm going to die and there's a mortality rate you got to bring in here, which means if I have a lease that expires in 20 years in my office, you might say 20 years from now, I'm going to assume the business shuts down and I'm going to get whatever I can get for my physical assets. So liquidation values for companies where you think, hey, you know what, there's a finite life here, I've just not dealt with it. Which brings me to the third approach, which is the stable growth model. And this is by far the most misused model in all of finance. It's a deadly model in the wrong hands, and unfortunately it's in a lot of wrong hands. And here's why. The terminal value is what? Always the cash flow 1 year after. Always remember that. When you get a terminal value in year 10, I need the cash flows in year 11. That's just a present value feature divided by R minus G. Look at the denominator. You see the potential for abuse here? Let's say you value a company and you come up with too low a number. Don't mess with the growth rate in year 1, year 2. It's so much work. You know what you should do? Go to the terminal value and just tweak the growth rate. Make the 1.5 into 1.6 and 1.7. It's just a little bit at a time. And if you don't watch yourself, what's going to happen? The G will keep climbing and climbing, and soon you'll have what I call Buzz Lightyear valuations. Because as G hits R, what happens to value? To infinity and beyond. Don't even ask me what's beyond, because I've actually had people turn in DCF valuations, and usually they'll send me a spreadsheet. There's something wrong with DCF. I'm getting a negative value. You know what they've done? They put in this 15% growth rate forever. It's actually higher than the R. They have this big negative. They don't even think about the logic or the lack of logic in what they've done. They've essentially said, this is an equation. I plugged in the numbers. What's wrong with the equation? To which my response is, what's wrong with you? If you lost sense, basically it's common sense. You look at the numbers and say something is wrong. So I'm going to introduce some rules on the terminal value that if you follow, your terminal value will stay at least in your control. So let's start with the first number. Okay? There is a growth rate. That growth rate cannot exceed the growth rate of the economy in which you operate. Mathematically, it's impossible to do. Why? Because if you let a company grow at a rate faster than the economy, it is going to become the economy. Then what? Globalization. Keep doing it. 25 years later, you'll be the global economy. Then what? That becomes almost an insurmountable battle. So this is not a question of what do you think, what do I think? It's basically, you're saying should it be nominal or real? Well, by the time you get to your terminal value, you've already estimated cash flows for the first 10 years, right? So I'm going to ask you, did you estimate them in nominal or real terms? If you have no idea, then you shouldn't probably be asking nominal or real. You should probably be checking, are my numbers nominal numbers? And if they are, your terminal growth rate should be a nominal growth rate. And now we're faced with a second problem, right? Because if you decide that this is going to be a cap, you now have to estimate the nominal growth rate in the US or global economy? Not right now, but 10 years from now, forever. You're saying, I'm going to hire a few economists, spend a lot of money, don't waste your money. These guys have no idea what the growth rate will be this year. Forget about 10 years from now. So I'm going to say this is a very simple proxy. And it's a proxy that's already in your valuation. It is the risk-free rate. And this is actually a very depressing thought right now, right? Because what if I just constrained your terminal growth rate to be if you have a US dollar valuation? 0.4%. You're going to bitch and moan about this, but you know what? You're also benefiting from this when you compute a cost of capital, right? So if you decide that this is temporary, that risk-free rate will go to 2% 10 years from now, that's fine. Then your growth rate can go to 2%, but they have to move together. So I've made this argument that the risk-free rate should be the cap on your growth rate for a long time, and of course you get pushback. That sounds really low. Should kind of go higher. So I'm going to give you my argument for why the risk-free rate is a good proxy for the nominal growth rate in the economy. If you break down a risk-free rate, this is called the Fisher equation. You can break it down to expected inflation and an expected real interest rate. This is not even a theory or a hypothesis. It's just a breaking down of the risk-free rate. If you look at the nominal growth rate in the economy, it's expected inflation plus expected real growth. So if you compare those two equations, the expected inflation is in both, so you can take them out. The question becomes, what's the relationship between the expected real interest rate and the expected real growth rate? And we talked about this when we talked about implied equity risk premiums, and if you remember the growth rate I used there was the risk-free rate. In the long term, and that's all you care about in the perpetual growth model, your real interest rate has to converge on your real growth rate. You're saying that's very theoretical. Does it really happen? So let me look at the numbers. This is actually a breakdown by period of what the T-bond rate was during that period, what the inflation rate and real GDP growth. So if you look at the entire time period, 1954 through 2015, the update is on my website through 2019, the T-bond rate was 5.93%, but if you add the inflation rate and real GDP growth, it was 6.7%. Every decade, for the last 6 decades, if you look at the T-bond rate at the start of the decade, it has been the best predictor of the nominal growth rate over the rest of the decade, better than what you can get from economists, from consensus views, It is kind of scary that this one number that's in the bond market, you know why? Because there's trillions of dollars behind that number. There's real money. I trust numbers where there's money behind a number, over numbers where somebody says, I'm an expert, let me tell you what the number is, because this is real money driving it. So right now it is going to create this issue of when you get to your terminal value, I'm not going to let you grow very much. Which means that if you believe your company has a lot of growth, you might want to extend the growth period. But when you look at that risk-free rate, it becomes a cap for the growth rate, and it's an issue of consistency. Which is, if I give you the benefits of a low risk-free rate in your cost of capital, I've got to hold back on what your growth rate is. And that's why I said, if you feel that today's T-bond rate is too low, it's temporarily low, and I think you might have a case to make. It's a panic-driven, people are running to that over the next 10 years, the rates are going to go back to some more reasonable number. And I'll let you pick the reasonable number. I don't even care what you pick. Let's say you decide to go to 3%. I'm going to let you use a 3% growth rate. But remember, that 3% risk-free rate after year 10 will also push up your cost of capital. I don't think it's going to make much of an effect on your terminal value. What drives terminal value inconsistencies is making one set of assumptions in your risk-free rate about the future and a different set of assumptions about nominal growth in the future. So again, be prepared for this argument, because there are people out there who still use 2-3% growth rates forever, saying that was the nominal growth rate in the US economy over the last 40 years, while using risk-free rates of 1%, 0.5%, 0%, or negative. That's why I put the Heineken valuation to kind of illustrate that the two are tied together. Second, as you sit there saying, how long should I wait before I make my company a mature company? My only piece of advice is don't wait too long. Let's do a valuation. Let's suppose we sit down to value Beyond Meat. Lots of promise? Sure. All these vegans popping up all over the place. I mean, let's face it, Beyond Meat appeals to guilty meat eaters. I mean, let's face it, guilt is a big thing, right? If you eat meat, then there's global warming, what will Greta Thunberg say to you, kind of thing, so kind of become, or it's going to be driven by people who say, look, I can't eat red meat, it's bad for my health. So it's a subset. When I valued Beyond Meat last year, I got an email from somebody saying, how come you're not bringing in the big potential market that Beyond Meat has in Asia? And I said, what? There are hundreds of millions of vegetarians in India. They should be a good market. And I said, have you ever lived with an Indian vegetarian or eaten with an Indian vegetarian? You give an Indian vegetarian anything that resembles meat, it'll make them gag and throw up. I mean, Beyond Meat's selling point is what? It tastes like meat, it looks like meat, it acts like meat. Guess what? As an Indian vegetarian, if it looks like meat, acts like meat, I don't want to be anywhere within 50 feet of it. That's not the potential market, but you can see how you can misidentify a market if you don't understand the product. That's why the first thing I did when I valued Beyond Meat is I went and bought a packet of Beyond Meat at the grocery store to see what it tasted like. I don't like meat to begin with. I don't like Beyond Meat either. But that's not a reflection on Beyond Meat, the fact that I don't much care for meat. So it's, again, how you define your market can drive your growth rate. But Beyond Meat, you've got to be careful, again, not to let the growth rate last too long, because then you're going to hit that guilty meat-eating market peak, and you're going to keep going. So I'm going to ask you a very simple question. You're going to sit down to value a company, lots of promise. Could be Zoom, right? Take Zoom. Right now, lots of promise. And you're saying, how long should I allow growth at this company to continue above the growth rate of the economy? Less than 5 years, 5 years, 10 years, or more than 10 years? What do you think? Seems like the company has a future in front of it, right? This seems like the future. And the question I'm asking is, how long should I? What are the pluses and minuses here? It's a technology-based company, right? And to the extent that that technology holds up and it has networking benefits, you can say, I'm going to use a long growth period. But to the extent that it's technology-based, who knows what 3 years from now might deliver as technology? You know what the median growth period for a high growth company in the US is? I'll show you a graph to back this up in a few sessions, maybe 10 or 12 sessions. It's about 3 to 4 years. That's how long growth lasts at a typical growth company. In most growth companies, growth fades really fast. So when you sit down to value a growth company, one of the key questions to answer, and it's not easy, is how sustainable is this growth? And to answer that, you got to look at what kind of competitive advantages, barriers to entry. And this is, again, part of your story. So if you're valuing Beyond Meat, not only do you have to tell me, if you're valuing Zoom, not only do you have to tell me a story about how great the technology and how people are getting online, you got to tell me a story about why, after it succeeds, it's going to be difficult for another company to push it out. And with Beyond Meat, I think I can tell a story, which is, the way Zoom works is everybody who's in a Zoom room has to have Zoom on. So there's a networking effect. It's like Office. At some point, you used Office. Microsoft Office drove out all of the other competitors, because if you are on Lotus and there were 9 other people in the room on Excel, you very quickly realized that you either had to switch to Excel or you got fired. These were the days before you could even convert to your spreadsheets. So there might be a networking argument, but I'm saying that when you think about growth rates, this is not just a number you pull out of thin air. It reflects what you think about the company's barriers to entry and competitive advantages and how long they can continue. So we talked about the cap on the growth rate. Don't wait too long. Third, don't forget everything we talked about in the context of growth. What do we send all the sessions on growth? To grow, you have to reinvest. You can't forget that once you get to terminal value. So to estimate what I have to reinvest in steady state, remember growth can come from both reinvestment and from efficiency. Forget about efficiency growth once you get to terminal value, because in terminal value, since you're talking about forever, it's all got to come from reinvestment. And we now have the mechanism to compute what that has to be. So if you tell me your company will grow at 2% a year forever, how much will I need to reinvest? Or what do I need to tell you for you to figure out how much you need to reinvest? I need to tell you what kind of return you can make on your invested capital. So if you can make a 10% return on invested capital, to grow at 2% a year, you have to reinvest 20%. If you can make a 20% return on capital, to grow at the same 2%, you reinvest only 10%. This is one of my last chances in a terminal value to give you a benefit because you're an incredible company with really long-term competitive advantages is through that reinvestment rate. And it actually creates an insight on terminal value that kind of changes the way you think about terminal value. Because the conventional wisdom on terminal value is play with the growth rate. If you increase the growth rate, the terminal value will go up. That is not true. And to illustrate that, here's what I did. I took a company and I tried different growth rates in perpetuity. What's the conventional wisdom? As you raise the growth rate, the terminal value should explode, right? But then I computed what the terminal value would be as a function of what kind of return on capital this company was making in steady state, in perpetuity. The cost of capital is 10%. If this return on capital is 10% on its new projects, guess what increasing growth does to your terminal value? Absolutely nothing. I can use 0% growth, 0.5%. Why? Because as I'm growing, what I'm gaining with growth, I'm giving up in reinvestment. Think of it as taking zero net present value projects. That's what I'm doing if I'm earning a return on capital equal to the cost of capital. If I assume a return on capital less than the cost of capital, growing at a fast rate actually reduces my value. And if I earn a return on capital that's greater than my cost of capital, growing faster increases my value. The big assumption in terminal value is not your growth rate assumption, it's what kind of return on capital you accompany that growth rate with. When I wrote my first valuation book, I think in 1989. And the same year, the McKinsey valuation book came out as well. And the McKinsey valuation book, how many of you have read the McKinsey valuation book? It's, you know. You remember how the terminal value is computed in the McKinsey valuation book? No. It's computed, it was computed, now they've changed their minds, I think, as no plat over cost of capital. You're saying, what the hell is no plat? It's just EBIT times 1 minus T. They call it no plat. Why do they call it no plat? It's a great consulting trick, is to take something and give it an acronym that nobody quite gets and say, I know what no plat is. It's EBIT times 1 minus T in the numerator and cost of capital. There's no G in the terminal value equation. And for years afterwards, I would get emails from people reading the McKinsey book saying, hey, I'm reading the McKinsey book, the terminal value equation is here, I don't see a G, why isn't there a G in the terminal value calculation? To which my response is, email McKinsey, why are you emailing me? Yeah? But we both had the same publisher, I think they thought we hung out together, I don't know where, in a corner in Manhattan somewhere. Yeah? But I gave them the answer, it's actually in the McKinsey book. You know what McKinsey assumed in terminal value about companies? That if you're a mature company, you cannot make more than your cost of capital. It's actually pretty good logic, right? No competitive advantage lasts forever. They just said, no, after year 10, we're good. And if your return on capital is equal to the cost of capital, what happens? Your terminal value is the same whether you use a 0 growth rate or a 3% growth rate. So McKinsey's point was, why even messing with the growth rate? It's not going to matter, just use a 0 growth rate. The only problem is McKinsey itself provided evidence that its assumption that the return on capital goes to the cost of capital for all companies is not true. In an article that showed up in the McKinsey Quarterly, if you've never read the McKinsey Quarterly, it's a great pragmatic magazine. It's free, actually. Go on the McKinsey website, you can sign up for it. And the reason the research is so interesting is they mine a proprietary database that they have, which is all these companies that have used McKinsey as a consultant for the last 50 years, all the data is in there. So one of the questions they looked at was, hey, we know growth fades. So basically they had a graph that showed growth fading towards the growth rate of the economy. What happens to returns on capital as companies age, right? Because if you believe McKinsey, the return on capital should drift down towards the cost of capital as you become an older company. And they discovered that returns on capital stay up much longer than cost of capital. Doesn't mean they eventually don't go down, but if you stop after year 10 with the Coca-Cola and assume return on capital is equal to the cost of capital, you are going to undervalue Coca-Cola. But when you get to your terminal value, I'm going to give you a chance to tell me what you think about your company. If you believe that this company is going to fade quickly, the returns on capital are going to go to the cost of capital, set the return on capital equal to the cost of capital, but be ready then for the fact that your terminal value is not going to change as you mess with the growth rate. If you think your company is a special company, its competitive advantage will last for a long period, and you want to lock it in, the way to do it is with the return on capital much higher than the cost of capital. And if your company is terribly run and you see no way out of changing the way this company is run, you could actually give them a return on capital less than the cost of capital, and welcome to the circus, because every time you increase the growth rate, the terminal value will decrease. So think about that when you think about terminal value calculations. One aside here, if you look at a lot of DCF models, and you look at the terminal value calculation, I think it's almost hard-coded into these spreadsheets. And here's what you'll see. You say, this company is a mature company. I'm going to assume CapEx offsets depreciation. Go along with me. CapEx offsets depreciation. What's net CapEx? 0. Okay. Working capital requirements are negligible, which makes working capital 0. What's 0 plus 0? 0. What's 0 divided by any number? 0. So if you have 0 reinvestment, your reinvestment rate is 0. So what's your only growth rate that's consistent with that set of assumptions? 0 growth rate. And here's what kills these DCFs. They'll assume a 2% growth rate forever. You do that, your discounted cash flow valuation has left the tracks. You're creating a money machine. If you want to put in a growth rate after year 10, you have to assume reinvestment. And of course, the pushback you get is, what if I just grow at the inflation rate? That sounds like a logical thing, right? If you grow at the inflation rate, I don't have to build capacity. Why do you keep making me put this net capex in? What's the flaw in that logic? You're growing at the inflation rate, so it helps you on revenues, right? But if there's inflation out there, to maintain your existing capacity, what do you have to do? You have to replace equipment, redo. I mean, basically, it's not like the machines you have run forever. To keep existing capacity going, you at least have to reinvest back in existing capacity, right? Which means that if you have inflation helping you on revenues, you're going to have inflation hurting you when you reinvest. To replace your existing equipment is going to cost you more. There is no escape hatch here. There is no way you can end up growing forever without reinvestment. End of argument. There's nothing really to debate. We can debate how efficiently you grow after year 10, but don't tell me you found this magical way of growing without reinvesting. And finally, be internally consistent. When you make your company a mature company, you're growing, bring the growth rate down. You can bring it down to the risk-free rate. Give it the rest of the characteristics of a mature company. Like what? When you started your valuation with Beyond Meat, you might have used 11% cost of capital. It's a young company, it's a money-losing company, lots of uncertainty. But if over the next 10 years you make Beyond Meat into a $10 billion company with $1.5 billion in operating income, guess what its cost of capital should do as well? It should go from 11% down to some more reasonable number, a more mature company's cost of capital. Last year, the median cost of capital for a global company was about 8% in dollar terms, about 7.5% for a typical US company. You do a discounted cash flow valuation, I see 11% cost of capital forever, I'm going to push back and say this doesn't look like a mature company's cost of capital. I'm not saying every company is going to have a 7.5% cost of capital, but it's going to act like a magnet pulling your cost of capital towards it. So give your company the cost of capital of a mature company, make it reinvest like a mature company, give it a return on capital that's consistent with a mature company. Your company in year 10 is not the same as your company today, even though it has the same name. So when I valued Tesla and I got to year 10, people actually took the terminal value estimated in year 10 as a multiple of whatever they wanted to do and say, hey, that doesn't look right for Tesla, it looks like a low multiple. Tesla in year 10 is not Tesla today. Tesla in year 10, in my valuation, is a mature company. I've got to give it the characteristic of a mature company. So terminal value can run away from you. Keep it in perspective. Which brings me to the final piece of the discounted cash flow valuation. You're going to say, at some point you will have to value your companies. At some point you have to pick a company, so let me make that. And then you have to value the company. So the sequence has to be right. So as you sit there, you're going to face some choices. What cash flow should I discount? What discount rate should I use? What growth pattern should I pick? So I'm going to give you a very quick tour of these choices. First, the question you're going to ask is, should I do equity valuation or firm valuation? Because remember we said you could value the equity, you value the entire firm. I'll make it very simple for you. If you do it right, you should get the same value for the equity using both, right? So the question becomes, which is going to be easier to do? Equity valuation becomes fairly simple to do if you have stable leverage. Remember that free cash flow to equity calculation when the debt ratio was stable, it was easier to do? So if you have a company with stable leverage, what does that mean? It has a debt ratio of 20%, you think it's going to stay at 20% forever. You should probably do equity valuation. It's more honest, it's more direct. But guess what? Not that many companies are in stable leverage. You look at a company, you're not sure that it's going to go up or down. If you're uncertain about leverage, do a firm valuation. Because the reason being it's easier to reflect changes in leverage in a firm valuation because all you have to do is change the debt ratios and your cost of capital than it is in a free cash flow equity. So the first fork in the road, equity or firm valuation, becomes a judgment call on is leverage stable or unstable. And for 90% of you, the answer is, I have no idea. And if your answer is no idea, go with the firm valuation. If you decide to go the equity valuation route, you then come to a sub-branch. Should I use a dividend discount model or a free cash flow equity model? What's the difference? The dividends, I'm actually looking at what companies return. Free cash flow equity, I'm estimating what they could have returned. If you're desperate, you can't even estimate free cash flow equity, just go with the dividend discount model. I'll tell you the kinds of companies you're going to get desperate. You're valuing a bank, an insurance company, investment bank. Estimating free cash flow equity, you're going to start, but then you're going to get stuck. Why? You start with net income, and then I get to net capex and change in working capital. So I have no idea. There, use the dividend discount model simply because you've given up. It remains the last bastion for dividend discount models is in valuing banks and insurance companies. Even there, I'm reluctant now, but that was the only place we went because you said, I don't know what the free cash flow equity is. If you can estimate free cash flow equity for your company, I think you're always better off using free cash flow equity and looking at what the actual cash flows are than what the company claims it can pay in dividends. You use the dividend discount model for ExxonMobil right now. It looks incredibly cheap. Its dividend yield is 8%. If you assume they can sustain those dividends, why do you even bother doing a DCF? Just go buy the stock. But the reality is at a $32 oil price, there is no way, even with their big cash balance, that they can maintain that dividend. That's why we need a free cash flow equity model. Otherwise, you're stuck with the status quo, and you end up with these value traps. You buy a stock that looks cheap, has a high dividend yield, but it's going to stay cheap and continue to have a high dividend yield until the dividends implode. And once you pick your cash flow, your discount rate gets picked for you, right? Because if you pick cash flows to equity, the discount rate has to be a cost of equity. So the discount rate choice is actually out of your hands because once you pick the cash flow, and in fact, if you decide to do your cash flows in dollars, your discount rate, so all those consistency suggestions kick in. And if you decide, trying to decide what should I do, real or nominal, if you decide to go the real route, then you have to work because almost everything you deal with out there is based on nominal numbers. When I compute a historical growth rate in my company, it's not a real growth rate, it's a nominal growth rate. So when people talk about real as if it's easy to do, I say, look, make sure that you're getting the numbers in real terms, but there's nothing wrong if you decide to go the real route. And especially when the inflation is high in a currency, you might say, look, I'm better off valuing companies in real terms. And the discount rate, as I said, is going to get picked for you based on whether you did real or nominal. Finally, let's talk about growth patterns. So you picked a cash flow, you picked a discount rate. You say, what do you mean by growth patterns? If you have a company that's already a mature company, don't go looking for trouble. You can value the company right now with the terminal value equation. You ask me to value Toyota. I'm not going to put a 10-year growth period. We're growing to what? I might decide, hey, this is what it is today. I'm going to put a minus 2% growth rate forever. Incidentally, I forgot to mention, there's nothing in a terminal value calculation, whether you have an infinite growth rate, that prevents you from using a negative growth rate forever. You say, I've never seen it done. The fact that you've never seen it done doesn't mean it can't be done. In fact, I would argue that if you have a technology company, because with a negative growth rate forever, what are you doing? You're peaking your company in year 10, then you're making it smaller over time, which actually is closer to what real-world life cycles look like, right? It's only in DCF where every company becomes a dinosaur, this monstrous company growing at 2% a year forever. Where is there enough growth for all these companies to continue to do it? So I could value Toyota right now with a stable growth model. If I have a company like Levi Strauss, Levi Strauss is a pretty mature company, established business model, but it still has one place where it hasn't grown much, which is Asia. They get only 6% of the revenues in Asia. Let's suppose in my story I see Asians as wearing a lot more Levi's jeans. I might allow them to grow, but I'm not going to get carried away and give them 10 years of 30% growth. I might give them 5 years of 6% growth. In the end of 5 years, and say, look, we're fundamentally a mature company. I'm going to bring your growth rate down to 0.5 or 1% or whatever my stable growth is. Think of that as a two-stage model, a period of growth, and then you drop. But if I'm looking at Beyond Meat, I can't use a two-stage model, right? Because if I'm using a 30% growth rate for the next 5 years, first, it's not going to fall off the cliff to 1%. I need a transition phase. There's nothing fancy in growth patterns. You're basically trying to guide the company to steady state, and you're saying, how are they going to get there? So you got a cash flow choice, a discount rate choice, a growth pattern choice. I think of it like playing with Legos. When was the last time you played with Legos? This is the kind of market where we should go buy 3 boxes of Legos, stop watching CNBC, just play with Legos. So if you think about valuation as 3 boxes of Lego, you got the cash flow box, the discount rate box, and growth box. Every discounted cash flow model is some combination of those 3 choices. And in valuation, some of the Lego pieces don't fit. So if you did cash flow to the firm and you try to put a cost of equity Lego on it, it shouldn't fit. So basically, you're trying to be consistent. You're trying to devise the right model for your company. Right? And incidentally, if you use my simple Ginzu spreadsheet, that's effectively what I try to do is I try to give you a chance in that model to take any. You can use that spreadsheet, even though it's a 10-year high growth period, if you set the growth rate equal to your stable growth rate right from now, that's like treating your company like a mature company right now. So give it a shot. We have 4 more minutes, so I'm going to kind of set up at least what's coming on Wednesday. You take cash flows, you get a discount rate, you pick a terminal value, you follow every rule, you get to the end, you value your company. You think you're done, right? But this is where the real mischief begins. So on Wednesday, what I'm going to talk about are what I call the loose ends in valuation. What are the loose ends? They're things that drive me crazy. Because you finish your valuation, then what do? You add 20% for control. Then you knock off 15% for liquidity. You add 30% for this. And once you do that, why did you even bother doing a discounted cash flow valuation up front? So I'll at least set up the place where this part of this class was born. Because this wasn't there in 1986, 96, somewhere in 2007 or 8. Yeah? And I'll tell you how it got started. You know how academia works in the US? I work incredibly hard. They make me teach like 4.5 hours a week for like 35 weeks. And they give me only 20 weeks off. And because I work so, in fact, I made it even, I teach for only 9 hours a week for 14 weeks. And they give me only 38 weeks off. But because I work so incredibly hard, every 7th year I get the whole year off with pay. It's called a sabbatical. I'm sure most jobs have something like this, right? You worked hard. It's like very biblical. You work for 6 days, take the 7th day off, right? So I've had like 5 sabbaticals. In fact, academics measure their life in sabbaticals. So it was about 2 sabbaticals ago. And usually when people have sabbaticals in academia, they have big plans. They're going to write a book. I'm going to do research. So it was about 2 sabbaticals ago. I had a sabbatical, and I had a very simple plan. I wanted to do absolutely nothing for a whole year. I wanted to wake up every day for 365 days with nothing to do on my to-do list. And I must admit, I got a little ostentatious about this. So I went to Staples and bought one of those to-do things, the boards, and I got it home. And I set it up right above the little cubicle in my house where I worked, and I set it up. And as my kids came down, they were all at home then, as they came down to go to school, I pointed to my children, I have nothing to do today. Pissed them off no end, but they went off to school. And then I made my fatal mistake. My wife came down the stairs and I said, "Hon, I have nothing to do today." She said, "Really? Want to walk the dog?" I walk the dog, I come back, there's something on my to-do list. I said, "What the heck is this?" Pick up bok choy at the grocery store. I had no idea what bok choy was. I was too embarrassed to ask. I walk around. Finally, look, it's not a seafood, it's not a meat. It turns out to be ugly looking cabbage. 2 hours later, I come back with the bok choy. Another item on my to-do, pick up kids at this. So after the 5th or 6th item like this, I said, I've got to find things to do to keep my wife off my list. I'm getting desperate. I get an email from the editor of CFA magazine, a magazine I didn't even know existed or read. So would you write a 1-page article for us on valuation? My first reaction was, I'm on sabbatical, I want nothing to do. But then I remembered I needed things to do to keep my wife off my list. I said, sure. And I'll tell you, it's the only thing I've ever written that's brought me hate mail. You know how difficult it is to get hate mail in valuation? Nobody's ever written that. I hate you for using bottom-up betas. It doesn't evoke that kind of emotion or implied equity risk premiums. Maybe Tesla, I walked the edge. But it got me the hate mail for 2 reasons. One was the title of the article. I said, stop the garnishing. I was talking about this process of adding 20% for this. And I might have used the word arbitrary to describe these premiums and discounts that got added on. And one of the hate mail emails that came in said, if you don't like what we're doing, why don't you come up with a better way of doing it? And I thought that was a fairly reasonable question. I said I have 11 months left in my sabbatical and I need things to do to keep my wife off my list. So every month I picked a different loose end. I start with control, then liquidity. So on Wednesday what you're going to see is my 11 months of loose ending. And essentially I said if I started from scratch, this is how I'd value it. So we're going to start with cash and then cross holdings and other assets. So we're going to go on a journey on Wednesday that's going to capture that 11 months of sabbatical that I ended up doing something with. So I'll see you on Wednesday.
Professor, sorry, I have a question regarding my quiz. If I'm reading this right, this is minus 12.
Just a minute.
Cool.
Can I ask you one quick question? So when I use the calculation to calculate the DCF, so to calculate the total, so do I have to use the market value of it?
Good question. Because it's like a returning capital. But there again, if you're looking forward, because it's about target ratio. You put your company as a debt ratio that's book value based. If you feel it's market value based, you can use it.
So if I use the market value of the debts, also I have to use market value of the equity as well. Okay, thank you.
Hey, I have a mechanical question, but let's say I was thinking about the cash flow equity, and I figuring something out. Let me see. So if I run the dividends, if I do a 10-year and I run the divvies for each of, so it's truly cash flow cash flow to equity holders. But run the dividends for each of for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10.
Run it against what? What do you mean run it?
No, I mean run it down to an idea of it's like true equity flows to me, the investor.
Yeah.
I could do it that way, right? And then in year 10, I would take the terminal value less the net debt to get the equity value.
No, you also then have to count the accumulated cash balance you will have. Because let's say the company could have paid $100 every year, they paid $150.
Right.
Where does the extra 50 go?
On the sheet, on the balance
That's
sheet,
cash
yeah.
balance. So what you've got to do is keep track of
But
the cash balance.
but you net it off the debt.
Yeah, but all of that will be, at the end, you have to net the debt out anyway. So you can
Yeah.
But then you've got to estimate the free cash flow equity every year to get the accumulated. There's no way around having to estimate the free cash flow equity, because to get the cash balance accumulation over time, you've got to figure out how much cash is left over.
Yes, yeah. And
So
whether
you
the debt
have to
changes.
do the free cash flow equity anyway. And guess what? If that cash is invested at a fair rate, because that cash is not sitting as cash.
Yeah.
The value per share you will get by using what you did, which is take the dividends and build up the cash, will be exactly the same as taking your free cash flow equity and discounting it back at the cost of equity. Because what you've effectively done is the cash by itself is not hurting you or helping you. It's basically building up as a cash balance with interest income. So if you want to do that, that's fine. But I'm saying it's no less work, no more work. It's going to end up at the same value anyway. So why not just do free cash flows to equity right off the top? And we'll give you, because you have to do it anyway. You're going to do the free cash, and you're not, even though this company might pay none of that free cash flow equity out as dividends. But remember, the cash accumulated is partly yours.
Yes, yeah.
So basically what you're saying is that it doesn't matter whether I'm paid, as long as the cash is not put in a wasteful place.
Sure.
Wasteful as in kept as currency.
Yeah.
I'm okay
But
as
if it's in
long as
short-term paper.
the fact is Google might not pay me any dividends.
Yeah.
But I'm still valuing based on free cash flow equity, because that cash balance is building up in Google. I get a share of that cash balance as it's building up. So with free cash flow equity, you're not assuming the companies will pay out now or even in the near future what they can in dividends. You're just assuming that what doesn't get paid out is still yours.
Yep.
And as long as it earns a fair rate of return, you might as well act like you're getting it out every year.
Yes. But you're not getting necessarily, you're not getting it as a direct flow. You're getting in the valuation, in the internal valuation.
But eventually, even in your approach, there is a flow, right? The flow happens in year 10 when you add it on to your terminal value.
Exactly, yeah.
So there's no way around it. If it never flows to investors, we have a problem with public companies.
Right, of course.
We have a problem with what it means to own a public company, because ownership means at some point in time this cash should be returned.
Right.
So I think that every model assumes there's a flow. The question is when that flow happens and what you're assuming on this.
And the other one I think was, so I listened to people say this and they're like, so the free cash flow yield is 10% and the free cash flow is growing at 5%, so you should make 15% in the stock, right? Which is a very linear sort of, and the rudimentaries of that is basically exactly that. So the 10% somehow is driven to you, distributed to you somehow.
Go through again. So what do you have? So free cash flow equity is what?
No, it's like a different. It's a,
Yeah.
let's say the market cap is 100 million, and the free cash flows to firm are
Oh, firm, okay.
10%, and those free cash flows are growing at 5% a year.
Right.
And people like to say, and I think this is misused in the market, they like to say that yield, free cash flow yield plus growth equals what my stock will
That
return.
applies only if you have a stable growth model. You know, so if you have a company that's in mature growth, then it's just a basic algebra, right? Value is equal to D1 divided by R minus C, and you
Yes.
work it out, and then you can write R as D1 divided by,
Or
so basically it's
FCF1,
dividend yield plus C.
it could be-
So
yeah.
basically it's dividend yield plus growth.